Hello, welcome to the part 3 of the online lecture series on financial management. Today we are going to discuss value of a share or a company. My name is Prasenjit Roy. I have qualified PhD, NET, JRF and MCOM in accountancy and finance. Presently I am engaged as an assistant professor in the Pune Institute of Business Management at the Guwahati campus. So when you talk about the main financial goal, we should consider that creating value for the investors is the primary goal of financial management. This is because investors invest in any avenues or ventures with a focus to gain return on their investment. Hence, corporations where managers and employees they should work or they are basically working on behalf of the shareholders who own the business, and therefore they have an obligation to pursue policies that promote stockholder value. Okay, so we have discussed in our earlier video also, okay, there is a manager, okay, and there is shareholder. So basically shareholders are the one who provides capital to the business, okay. Manager are the ones who manages the business, okay. So they are not basically the direct employees of the business, okay. They are basically the person who is responsible for the operations of the business, okay. So shareholders invest in these companies or in the business with an anticipation to gain return on their investment, okay, returns on their investment. So, considering this, let us take an example of the top 5 private banks in India who are listed in the stock exchange, and this is a trading chart of all these 5 banks, okay, from July. Okay, so the top bank is HDFC Bank, which has the last price being shown as rupees 1085.65 per share value, okay. Kotak Mahindra 1356, followed by 363.95 for ICICI, Axis Bank 433 and Bandhan Bank 325. Okay. So here one would observe that Kotak Mahindra has the highest share price, but the focus but the criteria for largest company is not the share price but the value, okay, but the value of the company. So this is the value of the company, okay. This price is multiplied with the number of shares that are there in the market, number of shares, okay, outstanding in the market. Okay, so these shares are circulating in the market, which is derived with this value, and the market capitalization of the company is considered as a factor for the valuation of the business, okay. So financial management ensures that the value of the companies go up, okay, value of the companies go up. This will only happen with the help of financial management by minimizing the cost, okay, minimizing the cost and taking up decisions that boost the growth of the company, okay, that boosts the growth of the company. So in a way, okay, we can observe that every company would focus for profit, okay, but profit is a short-term concept, okay, profit is a short concept, okay, because you see profit only focuses in yearly gains, okay, but shareholder, they don't invest in the company for yearly gains, they invest for long-term gains, okay. For them, investment happens from a long-term perspective. That's why the share value affects this return on their investment, okay. We'll understand this with a couple of more examples taken in the Next slides. Okay, so let's take the case study of HDFC Bank. So HDFC Bank, we'll get into the operations and the establishment of HDFC Bank first. Okay, HDFC Bank was incorporated in the year 1994. Okay, with its registered office in Mumbai. The bank commenced operations as a scheduled commercial bank in January 1995. As on December 31st, 2019, the bank has a nationwide distribution network of 5,345 branches, okay, with 14,533 ATMs in 2,787 cities. Okay, the authorized capital of the bank is around rupees 650 crores. Okay, 650 crores. So basically, authorized share capital is the maximum capital the company can issue. Okay, company can raise. Maximum share capital. Okay, company can raise. We'll discuss these types of share capital in a separate video, but for now we should understand that authorized capital is the maximum share capital a company can issue. Okay, out of which there is a paid up share capital, that means which is already issued. Okay, so for example, if 100 is my authorized share capital, I am issuing 20, there will be issued capital. Okay, out of this, say suppose 20 is subscribed by, okay, investors, and it's paid by them, okay, to me. So this 20 rupees will become the paid up capital. Okay, paid up capital. This will be authorized capital. Okay, this is a small example. So here the paid up capital, okay, comes to this much amount with almost 250 crores equity, over 250 crores equity shares of rupees 2 each. In 1994, the intrinsic value, okay, intrinsic value, it means the natural value, okay, value without any addition or any kind of premium on the value. Okay, it's the par value, okay, face value of the share. Okay, it's rupees 2, but when it was issued, it went to the market and due to the demand, okay, it was around rupees 4. Okay, so suppose now this is the historical view of the HDFC share price growth. Okay, so it starts from 96 when trading began. Okay, this is a yearly data, 96, 97 to 2020 July. Okay, so here the share which were subscribed by, which are paid up by the investors, it was rupees 4. Okay, now say suppose I have, as an investor, okay, I have invested 1 lakh of rupees. Okay, so with 4 rupees per share, I would get around 25,000 shares, right? This one is in 1996 at rupees 4. Okay, now as an investor, my entire goal is to get an appropriate return on my 1 lakh. Okay, why? Because see, instead of going for any safer investment, okay, my focus was company's share. Okay, company's share. I could have invested the 1 lakh in bank deposit. Okay, I could have invested the 1 lakh in mutual fund or in insurance, but yet I chose HDFC, okay, bank. Why? Because I thought that the return might be more here because it's an upcoming company. That's why it is beneficial for me to invest in HDFC company or HDFC bank for this example. Okay, plus the risk in this company form of business is more because there are so many factors such as competition, demand, okay, then supply of the product and environment, etc., which might affect the company's growth. Hence the risk is more. Yet if the company performs, okay, then value of the company goes up. Okay, here company will perform when they mitigate the risk. Okay, that means controlling or managing the risk, okay, through financial management. Okay, through financial management, then the return will go up on the investment. This is where financial priority or financial goal of financial management is, okay, is increasing the shareholder value. Okay, now coming back to the value, okay, I have invested 1 lakh rupees, okay, at rupees 4 per share, which comes to around 25,000 share. Now when comparing it with the present day, okay, let's take the example of 1st July 2020, okay, where the value stands at rupees 1,109 rupees, right? So what would be the value now? So I just have to multiply 25,000 into rupees 1,109 rupees. Okay, so it will come to around above 25 crores. Okay, so my investment of 1 lakh, okay, my investment of 1 lakh is giving me now above 25 crores. Okay, above 25 crores. Okay, from 96 to 2020. So this is the work of financial management to increase the value of the shareholder, okay, of the company. Ultimately the company's value will go up, which we have seen in our earlier slide, okay, in our earlier slide in this example. Okay, so here we should only remember this, that profit is a short-term concept where company, of course, they have to deal with profit, because without profit they can't survive, and without profit they can't issue dividend. Okay, so after achieving profit, their focus should be, or you can say the main focus should be, to increase the shareholders value. Okay, how? By issuing dividend, okay, or by future investments, okay, in new projects, okay, such as expanding the business. Okay, like you can see now where HDFC has a network of 5,345 branches. That means the customer base has increased, right? Customer base has increased. So this has created a situation where the company is earning more. Okay, ultimately it will reflect on the profit, which will again reflect on the value of the firm. Okay, so the bottom line is, in financial management, the utmost or primary goal is to increase the shareholders value, and managers and the employees should work positively towards that. So here, determinants of value of equity share. When you talk about determinants, the first factor is risk and return. Okay, risk and return. So one should understand that when you talk about risk and return, okay, we have a phenomenon, okay, which we consider as high risk, okay, derives with high return. Why? Okay, high risk derives high return. So do you know why? Because high risk, okay, high risk creates a perception that the investors' money, okay, investors' money, okay, might be lost. Okay, why? Because company might not do well as per the expectation. Okay, so that is a kind of risk. Okay, it's not certain, but due to environmental factors, due to business environmental factors, company might not do well. That is a question. Okay, so due to that risk, okay, investors are undertaking that risk, for which they, okay, they ask for a premium. Okay, premium. They ask for a premium. Okay, this premium should be of high return. Why? Because, for example, okay, suppose Mr. A has rupees 1 lakh of rupees 1 lakh. Okay, he is thinking, or he wants to invest this 1 lakh, okay, in any kind of business, okay, so that it is not sitting idle in his home. He wants to invest somewhere. Okay, now he has so many options. Okay, we'll focus from risk point of view. Okay, those who are not aware of risk in terms of types of investors, kindly consider the other video in my channel. Okay, types of investors. Okay, so now continuing to this example, say suppose 1000 rupees, when we observe that, okay, the most lowest risk type of investment we have is fixed deposits. Okay, after that we have mutual fund. Okay, after that we have individual shares. Okay, equity shares. Okay, so why these are FD is less risk? Because return is already declared by the company. Okay, because banks already declare the return 10%, okay, per annum. Okay, mutual fund, although they doesn't declare the return, but there is an advisor, okay, who makes you realize or makes you understand about the consequences of your investment. Okay, and based on the track record and compilation of all the securities, you might gain somewhere. Okay, but for equity shares of a company which is new, okay, suppose a new company, no one is going to give you an advice. Okay, it all depends on your understanding whether this new company is going to do well or not. Okay, because there are so many competitors in the particular industry. Okay, there are so many business factors. Okay, demand, okay, geographical location of the company, etc., etc. So the risk, okay, the risk is high, okay, in this kind of investment. Okay, now when investors are taking this risk, okay, suppose Mr. A is willing to take this risk. Okay, this willingness affects the anticipation of his, okay, investment. Why? Because he is foregoing fixed deposit. He is not investing in fixed deposit. He is not investing in mutual fund, although the return is already declared. Okay, although the return is already anticipated here, but yet he is undertaking this high risk. Okay, due to which he expects higher return. Okay, due to which he expects higher return. That's why we always, okay, hear this statement: high risk gives us higher return. Okay, why? Because of the willingness of the investor to undertake this high risk, for which he expects a premium. Okay, because he is foregoing this opportunity from other less risky investment. Okay, that's why this is one of the determinants of, okay, equity share. Okay, risk and return. Okay, now moving on, we'll often come across this term known as intrinsic value. Okay, intrinsic value and market value. Okay, intrinsic value and market value. So intrinsic value is nothing but the true value. Okay, it's suppose let us take this example of any product. Okay, suppose Parle-G. Okay, Parle-G biscuits. Okay, now when biscuit is manufactured, okay, it has so many raw materials, okay, machinery, marketing and distribution. Okay, these all are the cost, right, plus the profit, okay, which comes to MRP, right? Okay, so the actual value of Parle-G biscuits is known by the manager or the owner, okay, because they are producing it. As a consumer, we only know the maximum retail price, right? We don't know the cost of production, okay, cost of production, cost of distribution, cost of marketing, etc. Okay, suppose the cost of production this on this excluding the profit is 80 rupees, okay, and profit is 20, but we only know the price as 100 because we don't have this information, okay. So intrinsic value is of this nature. The intrinsic value of this biscuit is 80 rupees, okay. This 20 rupees is added and then MRP is made, which is the market value, okay. Now when we talk this in regard with shares, okay, shares also has an intrinsic value, although it will be not regarded in terms of cost of production and cost of distribution, okay, but intrinsic value, okay, intrinsic value is the unit of ownership, okay, at face value, okay, unit of ownership at face value. So basically when we talk about, okay, intrinsic value, we should remember that valuation of a company is derived with the capital and the assets that is owned by the company, okay. So when we distribute this in terms of unit of ownership, okay, unit of ownership will get the basic price of our company, okay. So when we talk about intrinsic value, we should remember, okay, that there is a true value of risk and return, okay, and there is a market value of risk and return, okay. This derives the value of the equity share, okay. So when we are considering the risk and return, okay, here Mr. A is investing 1 lakh of rupees in the company, okay, based on the market price of the share, not on the, okay, not on the intrinsic value of the share, okay. For example, when we see in 96 the value of HDFC bank was rupees 4 per share, but in actuality, okay, the value of equity shares are rupees 2, okay, the book value of the share were rupees 2, okay. So when 2 rupees per share, okay, went up to 4 rupees per share, okay, I have invested in this 4 rupee per share, okay, in the market value of the share, not in the intrinsic value, okay.